Hello everyone, this is Zach Gardezy. I'm the host of Money Minutes. I'm also the founder and managing partner of Wealthstone Private Wealth Management. Here on Money Minutes, I like to talk with you about some of the latest market headlines and my outlook for what's ahead. And so for this week's episode, I want to talk about the PCE report, also known as the Personal Consumption Expenditures report, which is the Fed's preferred gauge of inflation. I'll also talk about the U.S. Misery Index and compare that to past presidential elections and how other presidents have done during their re-election campaigns with their U.S. Misery Index scores. And so let's get right into it. So PCE, which stands for Personal Consumption Expenditures report, is the Fed's preferred gauge of inflation. And the reason behind that is because PCE tracks consumer spending. It's also capturing a more broader range of goods and services than the more commonly known CPI report, which stands for Consumer Price Index. And also, PCE weightings are adjusted more regularly than the CPI weightings to capture things like, for example, spending in new products in the economy. And so the Fed looks at PCE data to capture, what's happening on an inflation front, how is consumer spending holding up, and how this should affect their decision to raise or lower interest rates. Now, why this is important is because on Friday, there will be an updated PCE report released for the month of April. Now, this will show us, is inflation heading in the right direction or the wrong direction? Now, initial forecasts are showing us that the PCE report will unfortunately be a negative one, where inflation is heading in the wrong direction. And we're seeing with the 10-year Treasury yield, interest rates are starting to go up as a result. And the market is starting to price in a negative PCE report, which the reason why this is happening is because if the PCE report is negative, the Federal Reserve is likely going to push back their long-awaited rate cut. And just recently, we've seen Goldman Sachs come out and talk about pushing back their expectations for the first rate cut to the month of September. And as I've mentioned on previous episodes of Money Minutes, I also think that September is when we'll get the first rate cut. And so I'm interested to see what happens on Friday, but we'll likely get a negative PCE report, and this does have implications for client portfolios. Everything from the types of bonds you should hold in your portfolios to how you're invested in the stock market. So it's really important to pay attention to this Friday's report and analyze, are you invested appropriately based on what's happening in the economy. So the U.S. Misery Index score, it's an interesting name, and the data is pretty easily derived. It's unemployment plus inflation. And so I wanted to focus on this because, really kind of shifting gears and talking about the presidential election is important because it's coming up. And as a long-term investor, it's going to affect everything from your portfolio in terms of your investments and sort of long-term positioning to things like financial planning, because the 2017 Tax Cuts and Jobs Act is going to expire at the end of 2025. That covers everything from estate taxes, capital gains, income taxes, retirement plans. I mean, there's so much that will either change by that tax code expiring or maybe a new tax code, depending on what happens with Congress and the presidential election. And so as we get closer to the election, I want to continue to provide you with relevant content, but bring it to you in an unbiased format that talks about not only finance, but politics and intertwines the two because they really are interconnected. And so the U.S. Misery Index score is an interesting data point to start with. As I mentioned earlier, it's derived quite easily. It's unemployment plus inflation. And so, of course, the higher the score, the more miserable Americans are because you've got higher unemployment and higher inflation. Now, I focused on presidential elections where the presidents, under their election year, their U.S. Misery Index score was greater than 7. And 7's really the cusp of a good score because, let's say you've got 2% inflation, which is the target, and you have 3 or 4% unemployment, you're really close right there to a good score. And so President Biden, under his current administration as of the month of April, the Misery Index score for him is 7.24. And again, this is because inflation has remained quite sticky, although unemployment's relatively low, historically low, quite frankly. And so when you look at those two data points and you look at his Misery Index score, A 7.24 is not a terrible score because the average is 8.6, but it is above or out of range for what's considered a good score. And so I looked at past presidential elections going back to 1956. I just wanted to see who's won their re-election campaign with a score greater than 7. And only 4 presidents have done so. President Reagan, President Clinton, President George W. Bush, and President Obama. Each one of those presidents had their own interesting story in terms of, what's happening in the economy or the world during their re-election campaigns. And so President Biden will need to focus on his story to have any chance of winning because his, misery index score is really not the greatest. And so I just thought that was an interesting data point. As I mentioned, the outcome of this election is going to be very important for long-term portfolio positioning and also what you do from a financial planning standpoint. And so thank you so much for tuning in to this week's episode of Money Minutes. I look forward to catching up with you all again next week.